Have you ever dreamed of becoming a millionaire? What if I told you there's a surprisingly straightforward, time-tested strategy that could get you there? It's not about risky stock bets or trying to time the market. It's about a powerful, patient approach called the dividend growth strategy. This is the exact method legendary investors have used for decades to build incredible wealth, and today I'm going to break it down for you, step by step. This isn't just theory. It's a practical roadmap you can start following right now to build your own financial empire, one dividend at a time. So, what exactly are dividends? Think of it this way. When you buy a share of a company, you're buying a tiny piece of that business. They can reinvest all the profits back into the company to grow it further, or they can share some of those profits with their owners, the shareholders. That share of the profits is a dividend. It's a real cash payment deposited directly into your brokerage account, simply for owning the stock. It's like getting paid to be an investor. Now, you might be thinking, a few cents or dollars per share doesn't sound like a millionaire-making strategy, and you're right, if you just take that cash and spend it. But here's where the magic happens, the core concept that supercharges this entire strategy, reinvesting your dividends. This is the secret sauce. Instead of spending that dividend money, you use it to buy more shares of the very same company that just paid you. Let's imagine you own 100 shares of a company. They pay you a dividend. You take that money and buy, let's say, 2 more shares. Now you own 100 shares. What happens the next time the company pays a dividend? You get paid on 102 shares, not just the original 100. This means you get a slightly larger dividend payment, which you then use to buy even more shares. This creates a snowball effect. This powerful force is known as compounding, and Albert Einstein famously called it the 8th wonder of the world. He who understands it, earns it. He who doesn't, pays it. With dividend reinvesting, you are firmly on the earning it side of the equation, but we're not just buying any company that pays a dividend. That's a common mistake. We're looking for a specific type of company, a dividend grower. These are high-quality, stable, and established businesses that don't just pay a dividend, but have a long, proven history of increasing that dividend payment year after year after year. Think of household names, companies that have been around for decades, weathering all sorts of economic storms. Why is the growth part so crucial? Because it gives you two powerful engines for wealth creation. First, you have the compounding from reinvesting your dividends, which we just talked about. Your snowball is getting bigger. But second, the company itself is giving you an annual raise. If a company increases its dividend by 7% per year, your income from that investment grows by 7% even if you do nothing. When you combine that annual raise with the power of reinvesting, the snowball doesn't just get bigger, it starts rolling downhill faster and faster. This is the dual-engine rocket ship to building wealth. So, how do you find these amazing dividend growth stocks? We're looking for what are often called dividend aristocrats or dividend kings. A dividend aristocrat is a company in the S&P 500 index that has increased its dividend for at least 25 consecutive years. Think about that. 25 years of consecutive Increases means they've raised their dividend through recessions, market crashes, and global crises. These are incredibly resilient businesses. Dividend kings are even more elite, having increased their dividends for 50 or more consecutive years. Finding these companies is easier than you think. You can literally search online for dividend aristocrats, list on Fantem, but don't just. Do a little homework. Look for companies with strong financials, a reasonable amount of debt, and a healthy payout ratio. The payout ratio tells you what percentage of the company's profits are being paid out as dividends. A very high ratio, like over 80%, might be a red flag that the dividend is unsustainable if profits dip. Alors, ratio 60%. Suggests the company has plenty of room to keep paying and increasing that dividend, even in tougher times. Let's put this all together with a hypothetical example. After 10 years, thanks to your contributions, the dividend increases. And the magic of compounding, your portfolio could be worth over $100,000. Not bad, but this is a long-term game. Let's keep going. After 20 years, that same portfolio could be worth over $350,000. Now we're talking. But what about after 30 years? By sticking to the plan consistently, investing and reinvesting, your portfolio could cross the $1 million mark. You've done it. You've become a millionaire, not through a lucky gamble, but through a disciplined, proven strategy. And the best part, your portfolio would now be generating tens of thousands of dollars a year in passive income from dividends alone, income that continues to grow every year. Now, I know what some of you are thinking. 30 years is a long time, and yes, it is. This is not a get-rich-quick scheme. This is a get-rich-for-sure strategy. It's about patience and discipline. The biggest mistake people make is getting impatient. They see their portfolio dip during a market downturn and they panic and sell. But as a dividend investor, market downturns are actually your best friend. Why? Because when stock prices fall, you're reinvested dividends buy more shares. It's like your favorite store is having a massive sale. When prices are low, you get more for your money, which accelerates your compounding and leads to even greater wealth when the market eventually recovers, which it always has. Starting this journey is simple. You'll need a brokerage account. There are many great, low-cost options available online. Once your account is set up, you can start funding it. Even if you can only start with $50 or $100 a month, just start. The most important thing is to build the habit of consistent investing. Many brokerages allow you to set up automatic dividend reinvestment, often called a DRIP plan. Make sure you turn this feature on. It automates the most important part of the strategy, putting your wealth building on autopilot. Then, start your research. Pick a few companies from different sectors like consumer goods, healthcare, and industrials to diversify your portfolio. Don't put all your eggs in one basket. These funds hold a basket of dozens or even hundreds of dividend-paying stock, giving you instant diversification. so one day you won't have to work for money. This strategy empowers you to build a stream of passive income that can eventually cover your living expenses, giving you true financial freedom. So, to recap, find high-quality companies with a long history of increasing their dividends. Reinvest every single dividend payment to let compounding work. It's magic. Stay consistent with your contributions, no matter how small. And most importantly, be patient and stay the course, especially when the market gets scary. This is the blueprint. This is how ordinary people build extraordinary wealth. The journey to $1 million starts with that first share, that first reinvested dividend. The best time to start was 20 years ago. The second best time is right now. Thanks for watching today. I hope this has inspired you to take a closer look at the power of dividend growth investing. If you found this helpful, please hit that like button and subscribe for more content to help you on your financial journey. Let me know in the comments if you're already a dividend investor or if you're planning to start. I'd love to hear from you. See you in the next video.